Hey, what's up, guys? You're watching Andy's Fire Club. Take a wild guess as to what my name is. So, in case you've been living under a rock lately, you know that the stock market has rallied really hard from the bottom of what we saw back in late March. And people have been asking me, do I think that it's been rallying too fast, too hard? And do I think that a second crash is coming? And before I answer that question, maybe I'll just present you with some facts and let you be the judge of that. And then I'll answer that question myself later. So, first of all, the unemployment rate for the US will hit 32% by a recent projection. And yeah, that's right, you heard that right, 32%. So, to put that into perspective, before this whole crisis thing happened back in, let's say, January, we were at like 3% or 3 point something percent. We were under 4% unemployment. And then now we're projected to hit over 30% unemployment. So that is absolutely staggering. And I know what you're going to say. I know you're going to say that once businesses open back up, the unemployment rate is going to drop, right? And all the businesses will hire back all the workers that they laid off and everything will be fine. Well, maybe not so fast. If you think about it, if you're a business and you had to lay off, let's say, half of your workforce, and then the lockdown ends, let's say the demand starts to return, right? People start to come back to your business, or maybe you run a restaurant, people start to come back at your restaurant. I feel like not everyone's gonna rush back into your restaurant, right? So you might only get like half of your clientele that you usually get before the whole crisis thing happened. And then you might not wanna hire back your entire staff just so that you can save some money because you don't know how many people are going to return to your business just because of the uncertainty that follows, right? So I think that it might take a while before the economy bounces back to, let's say, less than 4% unemployment that we saw back in January. And the second thing to note is that the S&P 500 PE ratio, which is just the average PE ratio across the entire S&P, is hovering about 21 right now. Now, to put that into perspective, to determine whether it's low or high, that's about the same level that we saw back in January last year. Now, if you compare the conditions back in January 2019 compared to now, you will notice that things are a little different, to say the least, between now and January 2019, right? If you think about what was happening back in January 2019, we were on the end of one of the biggest bull runs that we've ever seen in the stock market ever since the 2008-2009 recession. So I think that the market fundamentals were a lot stronger back in January 2019 compared to now, to say the least, right? So if you think about what's happening now businesses are just completely shut down. It's not just an issue like in 2008 where it was sort of the plumbing of the financial system that was in question. It's that right now the entire economy is just shut down. People are not going to work because they're being laid off, or people are working from home and productivity is a little bit lower when you work from home. And all these factors just influence the economy really negatively. And the more we're shut down, the higher the negative effects are going to be. And don't forget, now we're still shut down. I think the Canadian Prime Minister, Justin Trudeau, just announced that the lockdown here in Canada is going to extend into May at the very least. And it could be weeks before we even see an indication that the government is trying to ease the lockdown. I don't know about you guys in America, but at least here in Canada, we're not going to be able to go outside and continue life as normal until at least, I think, mid-May or probably late May, or probably even further, depending on how things go for the next few weeks. And even for America, I know the president, Donald Trump, is very eager to open up the businesses again. And I can certainly understand his desire to get the economy back up and running. But now I think if the American government starts easing up lockdown restrictions, they risk having a second wave of the outbreak. And that's definitely a huge risk that I don't know if people want to take. But I think it's sort of a catch-22, right? The more that we're locked down, the more the economy will suffer. But if we start easing the lockdown restrictions, we risk having another outbreak and things getting worse. So I think we're really in a tough spot economy-wise. And to me, it just doesn't make sense that the stock market is rallying the way that it does. And looking at technical indicators, now I know I'm not an expert in technical indicators, and I'm not going to try to pretend to be, but I know people have told me that according to the technical indicators, the volume of trading has been going down for the past few days. Now, that's apparently I've been told is a negative sign in the technical trading world. So we're seeing that the volume decrease, which might be an indication that the stock rally is finally running out of steam. And we might see a reversal very soon in the near future. Now, I think it's rare that we have both technical and fundamental analysis pointing towards a downwards movement in the stock market. And I think that's definitely something that you want to take seriously, no matter if you're a fundamental investor like me or a technical trader. So I think from both sides of the argument, you can see that the case for the market going downwards, it's a pretty strong case in my opinion. And now you guys know me, I'm always long-term bullish, right? So I'm always bullish on the stock market in the very long term. And by long term, I mean 5 to 10 years out. But I think in the near future, I am starting to turn a little bearish just because of all these different factors and all this rally of the stock market that doesn't make that much sense to me. And usually I don't like making short-term trades, but I think in the short term, if I do believe that there's going to be a near-term correction in the stock market, it would be kind of stupid to just sit by and do absolutely nothing when the stock market I know is probably going to be heading for a downwards turn very soon. Now, again, I could be wrong, of course, but I think it is valuable to sort of hedge against the risk of a downwards movement, which is becoming more and more likely by the day, in my opinion. So my plan is to put my portfolio in defense mode. And the question becomes, what can you do to defend yourself against a potential market downturn? So there are two things, in my opinion, that you can do to sort of hedge yourself against the risk and prepare yourself for a second crash if a second crash were to occur. The first thing you can do, and the preferred strategy on my end, is to keep a lot of cash. Now, when a market downturns and everything goes on sale, that's a brilliant opportunity for you to stock up on stocks, no pun intended, for you to stock up on stocks and at really cheap prices. So I hope you've been building a watch list of stocks that you're interested in but just haven't had the chance to buy just because the prices were too high. Now, if you follow my series, Watch This Stock, you know, you probably have a great idea of some of the stocks that I think are interesting that you might think are interesting as well. So be sure to watch This Stock videos if you haven't already to get some ideas in case you haven't finished building your stock watch list. But I'm hoping that you have a stock watch list already, and if you do, it'll be a brilliant opportunity for you to pick off some of the stocks on your list, just like you're shopping once the market downturns, if it does. Now, if you don't have any cash on hand, but you have some stocks that you're up on because you bought them back during late March when the stock market was crashing, then I think that it might be a good time to consider trimming some of your positions. Now, this is not to say that you should sell out of your positions entirely, right? So in case I'm wrong, so there's always the chance that I could be wrong. And if you sell out 100% of your holdings and just keep 100% cash, well, then what if I'm wrong and the stock market keeps going up and it just keeps going back up to where it was back in February or January, and then it just keeps going higher, right? Anything could happen. This is the stock market. So that's always a possibility. And if that occurs, then you'll be missing out on a lot of gains. So in my opinion, it's probably never a good idea to sell out of all your stocks and just go 100% cash, especially if a lot of your stocks are down big at the moment. But I do believe that there is some value in potentially trimming some of your positions if you're up on them. So for example, for the past few days, I've actually sold out quite a bit of my position in Shopify. Now, I still believe in the company in the long term, don't get me wrong. So I didn't sell all of them. I sold about half of my position in Shopify. And the reason why I'm selling Shopify in particular is because I was up pretty big. So I bought the stock back in November of 2019 when it was just trading under $400 a share, Canadian, by the way. I bought it on the Toronto Stock Exchange, so I'm talking about prices in Canadian dollars. So I bought it under $400 Canadian per share, and recently it has hit 700 Canadian dollars per share on the Toronto Stock Exchange. So I thought it was a great time to potentially cash in some of my gains and take some chips off the table. Besides, I think that the valuation of Shopify, especially in these markets, have just gone way too high. So I'll put up a chart of the price to sales ratio of Shopify compared to a lot of other tech companies. So Y charts actually put them on a different axis compared to some of the other tech companies like Amazon and Microsoft that I compare them to, just because they're miles and leagues ahead of them in terms of the valuation, which I think that at these levels, it's just way too high. Again, as I said, I still believe in Shopify and I still believe in the company in the long term. I think their business model is fantastic and their product is fantastic as well. But it's just hard for me to hold this stock when the valuation is this high, especially in this market and given the market conditions. But if I am right and the stock market does crash significantly in the coming weeks or even few days, then I have a potential to have that cash and buy back in to this stock at much lower prices, which I think is definitely a possibility. Now, the second thing you can do is buy gold. Now, gold has always been a good hedge against the stock market just because historically it's always been seen as something of value. So gold has been valuable for thousands of years and it continues to be valuable. So when the stock market crashes and people don't believe in stocks or just anything to do with paper money anymore, they flee to gold because the Fed can always print more money, right? Or governments can always print more money, but you can't make more gold out of thin air. So there's a limited amount of gold in the world and gold is always seen as valuable. So it's a great hedge against inflation and a great hedge against just the Fed printing money endlessly. So I think gold is another thing that you can consider buying into. Now, a great way to buy into gold is ticker symbol GLD, which is an ETF that is based on the price movements of gold bullion, so the gold bars, and it'll mimic the behavior of the price movements of gold. So you can actually buy into gold without physically owning the gold, which is a great benefit to you because you don't have to worry about storing your gold in your house and getting your house broken into and getting your gold stolen and all that stuff. So I think that's a great way to own gold and definitely something to consider as well if you think that the market might be crashing soon. And now, lastly, I just want to make a disclaimer that this is for educational and entertainment purposes only. Everything I've said is just my personal opinion. Please don't make any financial decisions on just my opinion. Please do your own research and don't sue me if you lose money. Overall, I think to sum everything up, I just think that the market is overvalued right now in terms of all the things that are going on, and this recent rally doesn't make that much sense in my opinion, and I'm definitely going to be taking a more defensive approach to stocks in the coming weeks. And right now I'm keeping about 30% of my portfolio in cash just in case, and I might consider upping my cash position a little bit more in the future as well. So with that being said, that's all I have to say about the situation right now, and we'll have to see how this plays out. So as always, be sure to give this video a thumbs up if you enjoyed the video, and consider subscribing if you like this series. Be sure to follow me on Twitter and Instagram. I'll leave the links down below in the description. And with that being said, I'll see you guys in the next video. Bye-bye.